Hi, I'm George Lambro. I run the futures room at Triple Threat Trading. My introduction into trading came during the dot-com era, trading stocks. And like a lot of folks, I had some ups and downs during that time. That was a period of time where I really went down the wrong road, doing all the wrong repetitions. Essentially all the things that we teach traders not to do at this point. Initially, when I was making mistakes, when it came to stocks, it was all about emotion. It was all about fundamentals. It was all about things that you hear in the news. All the wrong things. At this point, obviously things have changed quite a bit, and we're in the realm now where we follow setups and signals. We have defined occurrences on the chart that tell us where to get in, and we have a rule set that tells us where to get out. Whatever that rule set turns out to be, whatever your position management strategy turns out to be, whether you're breaking a position into several parts or whether you're all in and all out, we're looking at the chart to tell us when to get in and when to get out. Back in the old days, it was more of a position or buy and hold type strategy, and one that I preach against quite a bit now in terms of the buying and holding, because the buying and holding essentially says we have no idea when we're going to get out. We have no idea where our risk is. The only thing we can do to manage our risk is to buy something that might go up if this instrument starts to go down. And in my mind, that is not the correct strategy to use at all. The Dow over the last 12 years is up about 600 points from where it was back then. Some people will say, well, you're slightly above where you were 12 years ago. Let me add in a couple other things. The stocks that make up the Dow component have rotated out. So there's another part of the equation that always gets left to the side. You would actually do worse if you bought and held on for 12 years. The problem with fundamentals is whatever fundamental occurrence you're looking at, whether you want it to be an econ report, whether you want it to be something relative to a particular stock, whatever that fundamental item is, whatever that nugget of information is, everything else around it is changing. So if you want to just take, for example, a GDP report from the standard econ reports, or you want to look at an earnings statement, or you want to look at cash flow in a stock, those are all fundamental concepts. The problem with that one occurrence is everything that's surrounding that is changing. So every piece of fundamental information is variable by definition because everything that supports it is changing all the time. The two primary models that I'm showing right now are the Spitfire and the balance beam model. The Spitfire is for day trading and swing trading, and the balance beam model is for position trading, futures and stocks specifically. Each one of them has its own rule set and can be fine-tuned to the trader's liking, whether they want to be managing a single position, whether they want to go multi-contract. In the course, for each one of these models, of course, there's detailed manuals, there are support videos, there's time in the live room. This entire process gives a lot of repetition to what the responses need to be. And this is something that I focus on quite a bit, is I address the negative repetitions that drive poor performance. We want to recognize those so that we can make sure that we're not doing them. We can draw a line in the sand and say, hey, we're not going to do these repetitions anymore. I've got one client up in Canada who went through the process, model student, did everything exactly the way I told him, had the exact same responses that are typical, which is when I say, here's what you're going to do. You're going to be doing some back testing, a little bit of raised eyebrows. Hey, that sounds a bit like work. And then I put it right back to him and said, do you want to take trading seriously? Do you want to make this move so that trading becomes your business? And the answer was a resounding yes. So this particular client went in and did their back testing, and sure enough, I get the comment back, wow, I thought this was the craziest thing to do up front, but when I did it, it made so much sense. Now I have so much confidence. I've seen firsthand the evidence. I got the aha moment. I'm going to be able to respond to these in a sim account, no problem at all. Of course, you're not going to go live right then. You're going to go into the sim account. So he worked it out in the sim account. And then the best part of the story is the first 2 weeks that he went live, he went into a drawdown. In other words, he walked into the losing part of the model. Every model is going to have losses. One of the things that we want to work towards is identifying when those losses come, how big they're going to be, because we're likely to see those again in the future, and that we're properly funded. And this is where some folks have some difficulty, but not if you plan correctly. Well, here's what all the belief building exercises have done for this particular person. They decided to go live at the exact time I told them to go live. They happened to walk into a drawdown. You can't really control that. But what you can control is what your responses are going to be. And where some people could get cold feet and continue to go down the path of variability, this person did exactly what they're supposed to do. They were correctly funded. They knew the repetitions. They walked into a drawdown. What are you supposed to do? You're supposed to keep trading, because you're going to move on to that next expansive move for the market that you're trading. And sure enough, 2 weeks went by. They've been on a nonstop clip of profitability, up over $72,000 in about 7 or 8 months or so. I'm not sure of the last tally, but also the position sizing for their futures trading has also gone up 4 times from where they started. So trading a 4 lot now after starting with a 1 lot, and also expanding these strategies not only in the futures but to the stocks. Anybody can learn to do this. Literally, a 7-year-old child could come up and look at the charts that I'm showing them, and I could show them strength of signal 1, strength of signal 2, strength of signal 3. Take your position off here when this changes. Take your position off here when this changes. It's a very simple response. Again, you go back to the brick wall, are the traders who think that it needs to be more intelligent. They want things to be more complicated because they've been conditioned to think that to be successful, you need to be intelligent. This is the path. It's proven. It works.